In this video, we're going to discuss wraparound mortgages. So a wraparound mortgage is a type of seller financing, right? So the person selling the home in question is actually financing the buyer. And so the seller's mortgage, right? So the seller, let's say they still owe money to the bank on their mortgage, that's actually going to remain intact and they're going to keep making payments on it. And then the new mortgage, which is going to be extended from the seller to the buyer, that's going to wrap around, so to speak, the existing mortgage and cover those payments. So it's just kind of a complicated thing to talk about. Let's actually show an example, which will make it a little bit easier for you to understand, I think. So let's say this is you, and you want to buy a home from Susie, right? And you want to pay. Let's say you determine, hey, I'll pay $200,000 for this home. That's what I think it's worth. Right, I want to pay Susie this money to buy this house. And Susie owes, let's say Susie has an existing mortgage. So I'll put here an existing mortgage. So she borrowed money to buy that home, right? And she still has money left on that mortgage. And let's say that she has an existing mortgage of $35,000. And let's say this $200,000, that's what you want to be the sale price, right? You're willing to pay that. So normally what would happen, right, with a kind of conventional mortgage is you go to the bank, right? And you would go to the bank. Let's see, here's the bank. You go to the bank and you say, hey, I need $200,000, or you know, obviously you'd have a down payment and stuff, so it wouldn't be the whole $200,000, but let's just say you need $200,000 or you need this amount so you can buy this house from Susie, right? And then Susie would take that money, right, because she's getting paid all this money. She's getting the full amount, right? And she would take that and then pay off her own mortgage, right, after she paid her real estate broker and so forth. So she would her mortgage is going to get completely paid off, right? She's going to use the proceeds from the sale of the house. But let's say that you can't get money from the bank, right? Let's say that there's some kind of issue, the bank won't loan you money, for whatever reason, you decide that, you know what, it's actually better if I can get financing from Susie, right? Susie will be willing to lend me this money, right? Now, Susie's not actually going to give you the $200,000. I mean, it's silly, right? She's not going to give you $200,000 and then you just give her $200,000 back. What Susie's actually going to do is say, look, you'll have a mortgage to me, right? And you'll be making payments to me, right, based on this $200,000 plus some interest, right? So let's say that she says, so the mortgage here, so she conveys title of the home to you, and she extends a mortgage, right, or gives a mortgage, right? She's giving you a loan, and there's that $200,000, let's say at the 8.5% interest. Now let's just ignore the down payment and stuff to make things easier, right? So it's an 8.5% interest rate she's charging you. Now, what's the advantage to Susie of doing this, right? Why is Susie going to say, hey, you don't have to pay me the amount up front. You can just go ahead and I'll finance this and you just make payments to me. Why would Susie do that? Well, maybe Susie was having a hard time selling her house. Maybe it's kind of not a good market for people like you to get credit. And so Susie wants to sell her house faster, and she just decides that, you know what, this will help me sell my house faster and get and I want to move into this other home. So in addition to that, if there's rising interest rates, so let's say interest rates are going up, there's also another benefit for Susie, right? And so that benefit is this. Let's say that, remember Susie has an existing mortgage of $35,000. Well, let's say that $35,000 mortgage is at a rate, that looks terrible, is at a rate of, let's say it was 7%. 7% interest, right? Now, Susie is continuing to pay her mortgage, right? She's not going to extinguish her mortgage because she doesn't have $35,000 to just pay this off, right? Because you haven't given her a lump sum. You're making payments to Susie, right? You're making mortgage payments to Susie, not to a bank, right? But because she originally had so her 7% interest, now mortgage rates have gone up, and she's getting 8.5% interest. So she's got a spread, right? Because she's still making payments on her existing mortgage, right? That's the whole key, right? Your mortgage with her is going to wrap around her existing mortgage, right? So she's going to continue making payments on this $35,000, but it's at 7% interest, right? And then that $200,000 and everything, that's including this 8.5% interest. So she's really making a spread of 8.5 minus 7 equals 1.5% interest on this $35,000, right? Because you're paying her 8.5, and it's really 7 is all she has to pay. So she's making that spread, plus she's making the 8.5 on the remaining amount, right? So the 200,000 minus the 35,000. And again, we just ignore things like down payments. Let's just make this simple, right? So she's making 8.5% interest on that, and then she's also making this 1.5% interest on her existing mortgage. So now you say, hey, look, this looks great, right? You had trouble getting financing, and now you got financing from the seller instead of having to get it from a bank. And Susie gets to make this spread on her existing mortgage, and she gets to sell her house faster. It's a win-win for everybody, right? Well, there's one thing to keep in mind. There's a lot of risk for Susie, right? So there's a lot of risk. First of all, this mortgage, right, has to be what's called assumable, and they not have what's called a due on sale clause. Right? So sometimes, like when Susie had this existing mortgage with her bank, there'd probably be some due on sale clause, which says, okay, look, if you try and convey title to this property to anybody, the bank has the right to just demand payment immediately, to just accelerate payments and just say, look, you have to pay us before you can convey title of this home to anybody, right? Now, FHA loans and VA loans historically were assumable, and you didn't have this kind of issue with the due on sale clause. So you could do a wraparound with that. But if you don't have that kind of loan and it's got a due on sale clause, you might have to work it out with the lender, and the lender might say no. Or if you just do this without the lender's permission, the lender might come in and surprise you and say, hey, look, we got this due on sale clause, and you have a problem, right? So you've got some risk there on Susie's part. And then also, even if you say, okay, you know what, the loan is assumable, or the bank's not going to give us problems with due on sale clause, there's still risk with Susie, because what if you don't make payments, right? If you don't make payments to Susie, then Susie's going to have an issue, and she's not going to be able to pay her existing mortgage, in which case the bank might decide to foreclose, and Susie would be on